Good afternoon, everyone. I am Phillip Nelson, and joining me is Jennifer Appel. Happy to have you join us today to talk about NEPC's market outlook. We're trying a slightly different format this quarter. I'm sure many of you that have been with us over the years seen various different formats and discussions. And what was, I think, fair to say, an interesting, eventful, unusual quarter. Many other adjectives could be applied. We thought we'd start off with something just a little bit different in terms of trying to capture what changed, what didn't change with this last quarter, and also talk about some of the other kind of major items that we want to hit on in terms of our market outlook. First, just a couple of logistic points. We do have a slide deck that'll be published on our website, so that'll be available to you. Looking back, what are some of the kind of the keystones from this last quarter and other slides that you can happily read on your own. In addition, we do have time for Q&A, so there's a question and answer box that feel free to enter your questions, and we'll take those at the end of the session. And so with that, why don't we get going? And Jen, as I said, it was an interesting quarter. And I think one of the things that we spent a lot of time talking about is what actually changed over the last, let's call it 100 days. Did we learn anything, or did things not change that much? So maybe you could talk a little bit about that to get us going.
Yeah, I think there's a number of things probably that fit in both categories that you're talking about things that have and have not changed. But when I think about probably one of the biggest changes that we saw over the last quarter, the first thing that comes to mind is tariffs. Obviously, at the start of this year, we were talking a bit about some policy changes, but really just at the start of the quarter with those April 2nd announcements, they were just coming out much more harsh than expected in terms of scope and rates and the timeline as well. And I think that was kind of setting the tone for a lot of what we saw in the market over the last few months. First, with that really negative reaction from markets as it started to think through what might this kind of worst case scenario look like for the global economy. So especially relative to maybe some of our thoughts at the start of this year, it was a really meaningful escalation in the trade rhetoric that kind of suggested we would see this higher tariff regime in short order, which started to impact market returns. But there was a more of an interesting dynamic really after that, which it seems like that was the first week of the quarter, and then things changed a lot from there, where we went through almost the cycle of de-escalation happening on the tariff side, and now maybe perhaps we're on the upside of that once again with some of the announcements the last couple of weeks.
Yeah, we'd kind of have joked over the last quarter, the team of from April 1st to June 30th, could we have just taken 90 days off? And other than one day where we suggest everyone to rebalance because VIX popped over 50, and which almost always is a signal to rebalance back into equities. When you look back over history, you could almost look from the start and the end. You wouldn't know all the things that happened in this last quarter. And I think as we started to kind of think about what are some of the key messages we want to be sharing, with folks, I think one of the things was, sticking to your policy targets and really focusing on maintaining diversification, liquidity levels. I think to the extent that we talked a lot about tariffs in the last webinar that we did, I think we were hoping maybe to squeak out of that and not have to bring that back. But this last week, it's certainly, returning. And I think what's interesting is the market's not really responding as negatively to tariffs. Do you think we've somewhat kind of desensitized ourselves from a market perspective? And are we underappreciating maybe the impact of tariffs, whether that's from a consumption impact or inflationary impact?
I think that could be a little bit of it. And part of it is we just lived through the last few months where we did have this tariff on, tariff off type environment. So I think maybe there's a little bit of skepticism that all the proposals out there are going to hold. I also think that some of this is just due to this sentiment backdrop we have today versus what was there at the start of the quarter. If you remember, sentiment had deteriorated a lot coming into Q2 of this year because there were a lot of policy policy concerns that were out there. And now we've come up on a lot of those metrics. So I think we're just at a better, maybe a little less fragile starting point from that perspective. But the economic data side of things that tariffs can introduce, I think that's still a question mark at this point. And maybe so far it hasn't been quite as bad as folks had thought, with inflation seemingly supposed to move higher with tariffs, or job losses supposed to happen. We just really haven't seen that really bad downtick in data so far.
And I think it's important to emphasize, and many of you heard this before, what we view tariffs having an impact on. And at its core, tariffs really are a consumption tax. And if we look back over history, consumption taxes tend to have a reduction in economic activity and reduce consumption over time. And so there may be a brief period where headline prices increase because of tariffs. And what's really important is thinking about the volumes of goods and volumes of sales that maybe start to decline because of that price uptick. And so it's really hard to say it's an inflationary impact. And I think more our bias is say, over the long term, there are some deflationary signals that pop up because of tariffs. Now, to the extent you break and shift, global production cycles, the flow of goods and services, that can also then have an inflationary component to it, especially when you think about the health of labor market and the ability to be sourcing new workers, both from the U.S. and outside the U.S. Those are longer term things to think about from an inflationary standpoint. But I think it's fair to say, Jen, we are less concerned about inflation than maybe the Fed is. And I think one thing is you look at things that didn't change this year has been the Fed.
Yeah, and maybe just one other thing on that inflation front, just thinking about some of the data points that we've gotten recently. I think there is a little bit of evidence out there that we are seeing some of that one-time price increase come through, but there are still a lot of disinflationary or deflationary pressures that are offsetting some of that. So when we think about what the path for inflation might look like moving forward, some of it is that we could see some of that tariff noise kind of coming through the data and then rolling off. But if that's offset by some of these other factors, you may not see that uptick in the near term. So definitely fair to say that maybe we're a little less scared of inflation than the Fed is, given some of their projections and kind of their stubbornness that we've seen as of late.
Yep. And maybe just as a quick back and forth, maybe we can list a couple items in terms of, what are some things that changed? What are things that didn't change? Maybe you can give us a couple other items from this last 100 days or so in terms of, what has changed in your mind?
Yeah, I think one of the big things, just from a return standpoint, equity returns have been a really big shift over the last few months. And some of it is that we've had this tariff backdrop that we're talking about, but there were a lot of risks that I think the market was concerned about that maybe didn't materialize over the last quarter. Tariffs being one of them, but there was also some tax uncertainty that was out there. And now that is another thing that's kind of behind the market today. In addition to the fact that the boogeyman that was supposed to be in the earnings reports at the start of this year, we really didn't see that come through. And a lot of the guidance is AI was still pretty resilient. So I think a lot of those things just supported the market backdrop, and maybe there are reasons to think that can continue moving forward.
Yeah, and maybe in terms of that idea of resilience, I think another maybe kind of important reminder of things that really matter, and that we didn't see a very big change with this last year, is just the importance of jobs, and jobs in this country really drive the economy. And to the extent that we continue to see steady gains in employment, we don't see significant losses in terms of job losses. I've said this many times over the years, but it's an old Harry Truman quote that when your neighbor loses their job, it's a recession. And if you lose your job, it's a depression. But if there's not a lot of job losses, it's hard to see how economic activity actually starts to grind lower and slow down. At the end of the day, if you have money in your pocket, you're likely to spend it. And the data is showing that. And that's partially why we see the Fed not moving, is the jobs data has been healthy enough to not force them into making any other shifts. And from that standpoint, we might see kind of more of the same of not a lot of movement on that front over the course of this last year. And maybe one more thing, Jen, in terms of things that changed, and I'll hit one more, things that didn't change.
Yeah, maybe I'll jump to something that didn't change, because I talked a little bit about the volatility at the start of the quarter, but outside of the equity market side of things, there was some volatility on the interest rate side of things. So that was something maybe a little bit different, but why I'm bringing this back to something that didn't change is that there were a lot of questions around treasuries as a safe haven asset during that time that we were getting from our clients and a lot of investors. And fortunately, we did see treasury markets calm down after that little episode at the start of April. In our minds, really reaffirming their status as a safe haven asset. But I think it's been good to see how markets have reacted, and it seems fairly rational since then.
Yeah, and I think in that, what we did see a little bit of a change, for this year is the shift in the U.S. dollar and a little of the dollar weakness that we saw, which I think, especially in the context of April, spooked some folks in terms of thinking, is there a big flight away of capital from the United States? And I think it's fair to say, coming into the year, from most models, from most kind of valuation frameworks, the dollar was slightly overvalued. Now, you have to take a lot of grain of salt when you talk about currency models. They tend to work over 20 years if they do work. But at the same time, I think most would agree the dollar was on a kind of stronger, more overvalued path coming into the year. And to see, when sentiment reverses and there's a little bit of a shift in the narrative, to see kind of that pullback from the dollar, I don't think should be viewed as a significant surprise. And I think we don't view it as a shift away from the dollar as a reserve currency. There's really no alternative to the US dollar, and it's likely in our minds to remain the same. And I think on a kind of a final note, and when we're buffeted by a lot of these news, and it seems like we're getting a lot of new information, things are shifting and changing constantly. There's a couple of things that we can look to. Jen mentioned, there was a return of volatility. That was a little bit of a change this last quarter. But I think also what's really important is what didn't change is how powerful rebalancing is for client portfolios. Now, maybe a surprise how quickly markets recovered. I don't think we would have said it was under 30 days or whatever the number was. But there's certain things that we look to, whether it's, in our advice to our clients, or even, discussions internally. But when we see, peak levels of market fear, when we see market distortions, the simple, way to explain it is when you see VIX at high levels like we saw at the beginning of this last quarter, it almost always a signal to us to rebalance. And history has borne that out. And, something we encouraged when we last, met with you all in April, and that's clearly borne itself out. And now as we've kind of hit that higher period of excess, we're starting to think about how do we bring down kind of overweights in equities? How do we think about getting closer to our long-term policy targets? There's a lot of discussion on, should we be underweight, overweight? And I think what we'd encourage, kind of back to our outlook, is try to get as close as possible to policy targets, in a reasonable amount of time. Just there's been a lot of buffeting of markets over this last several months. And so with that, thinking about, this idea of, are we in a market bubble? So we wanted to kind of do something a little bit fun and just thinking about what's the bingo that we're looking for in terms of identifying a market bubble. So if we all had our bingo cards out there, you can imagine you have them at home. We'll give you a freebie with a little star in the middle. But just as we think about, what are those? And so Jen and I both kind of independently said, okay, we've got bingo. We can spell it out. If we thought about B, what does B represent? And so we both have kind of different versions of it. You're going to hear kind of our thoughts on B. So go ahead, Jen, and talk about kind of B and bingo.
Sure. My B, hopefully hyphens and multiple words are allowed in this game, but my B is buy the dip. So this is a phrase I think oftentimes gets thrown out there when you're talking about market bubbles. And to me, it seems like we've seen a little bit of evidence that this mentality has started to take hold over the last quarter, where we're seeing some pullbacks met with just buying in markets. Certainly, it wasn't the case at the start of April, but since then, I think you're seeing a little bit more of this dynamic. And when you take a step back and think about what does that mean, to me, it means that there's some type of underlying bullish sentiment in markets and almost this confidence that markets will continue moving higher in the near term. And I don't love this term, but I think there's a little bit of FOMO that's happening, or the fear of missing out, that folks are trying to chase returns in some sense, since market returns have been so strong as of late. So that bias that things can keep moving higher, that's a classic sign of a bubble, and it almost gets reinforced and embedded into thinking, since as long as that continues, that can have investors feeling good about their investments, their paper gains, valuations can keep going, and then money keeps funneling back into markets. So I think you have probably a fairly mild version of this at hold today, but this is something that you do tend to see take hold in market bubbles overall.
Yeah, and I think it's interesting. How long do you have a recovery to come back off that dip? And so my B was bulls. As we started this last quarter, in Q2, there was really negative sentiment. And the tariff announcements to start this last quarter really drove any sign of bullish behavior completely out of the market. And I think what's most fascinating is how hard it is to predict sentiment. I don't think any of us would have. We just saw a signal of markets acting really frightened. This is a signal in over almost all conditions in history, time to kind of go buy equities. And magically, I think we're still scratching our heads. Where did they go, and how did the bulls come back so quickly? But we're clearly back into a really bullish market environment. I think there's a lot of question marks on, can you extend the life of an equity bubble? How does it look? Are we in a bubble? And I think the reality is there may be a few names that look more bubblish, but the aggregate market and kind of let's call it the median equity market out there, both in the US and globally, just is not exhibiting kind of more bubblish type factors. So, do we have a bingo on, buy the dip and bulls for a market bubble? I think we're getting closer on the B here, but I think we all can kind of look a little bit in awe in terms of just how quickly sentiment has flipped and how bullish the market has recovered in terms of what we've seen the last, especially the last 30 days, especially.
Yeah, and maybe if we move on to the I, because one of the reasons I think we really can't have market bubble bingo today is because of the interest rate environment. So interest rates are my I, but I think this is really the biggest hindrance in my view to any type of market bubble forming, because when you think about speculation or excess building in markets, one of the things that you need for that is easy, cheap financing and a lower rate environment that fuels that debt expansion and risk taking and asset price inflation. And with the rate backdrop we have today, that is one piece that I just don't see. So I can't really check that off my bingo card at present.
Yeah, and I think the other my eye, sticking to the single word usage here, is just inflation. And it's not that inflation is holding the market back, but there is some worries about inflation, and maybe it's a legacy from post-pandemic in terms of the higher inflation levels then. But there is this legacy lingering fear of inflation. I think most evident that's in the Fed in terms of how the Fed is operating. I think we can all agree the Fed is moving slow. The inflation data, especially over the last 4 or 5 months, does not suggest that inflation's building, but it's speculative in terms of could we see more inflation in the future because of some policy action? And I think that is the real difficult question for the Fed, that is kind of keeping interest rates elevated and also holding back, I think, some CapEx expansion, corporate spending, worrying both on the demand side, what can inflation do if we saw any, and then also on the interest rate side, when will we see some, relief on interest rates coming down? And I think a couple of things just to think about, what you need in a market bubble. you need excessive leverage, you need debt expansion. And to the extent that we've seen that at certain times in the private markets and private equity, it's a little bit subdued right now in terms of ability to kind of launch M&A and kind of more of those classic animal spirits that we're just not seeing right now.
Yeah, and the only other thing I might add on both the interest rate and inflation side of things, one of the complexities that I think the current environment has with the Fed potentially lowering rates, that's one thing that could cause the bubble to form and get a little bit bigger. You've seen a little bit of it with the market reacting favorably to interest rate cut expectations getting priced in. So if we do get those rate cuts, that's another thing that could fuel the bubble a little more.
Yeah, and I think it's really interesting to what extent is the market discounting lower interest rates already. So May 2026, I think it's fair to say is almost a guarantee we will have a new chair of the Fed. That is when Chairman Powell's time is up as chair of the Fed, and whoever is likely put in place of that head of the Fed, I think it's probably the first question being asked in their interview is, what are you going to be doing with interest rates? And so I think it's very likely interest rates will be moving lower and probably moving lower than the current Fed regime is projecting. And to when does the market start to pick up on that? We're about 10 months out from when we'll have kind of a new Fed chair. But there is a certain point where, whether we have a nominee in name and they are speaking publicly versus the current, Fed Chairman Powell speaking, there's a certain point where market expectations start to listen more to the nominee than the current Fed chair. When that'll happen, I don't know. But I think we all can agree in 10 months' time, we're likely to see lower Fed rates pretty quickly. So as we kind of go through the BINGO, next on our list is N. I had new highs, and we're consistently setting new highs. You'll start to see a theme here. Clearly, what you need for a market bubble is setting ever and ever higher new highs. But I think one thing that's interesting is it's still limited to a small cohort of names. And this is one of the things that we've talked about in the past. There's a narrowness, there's an exception list to very few number of names are driving the market. And I think that's a really challenging environment to say we are in an aggregate bubble when we have a very few number of names driving the market.
Yeah, and one of those names was my N, NVIDIA. So they work quite well together. But I think part of the reason that I put this as part of my bingo card is that this is really at the center of the AI theme, the US market narrative, kind of everything that we've been talking about. And what's interesting is that because it's done so well over the last year or so, it has a very unique role in the US market in terms of its weight, like you're talking about with some of the top names, but also its margin contribution, the contribution to index level multiples as well. So when you look at those multiples at the index level, of course, everything's going to look expensive, but maybe pushing back on that a little bit, that it may not be expensive if there's earnings growth or fundamentals to kind of back that up a little bit. So NVIDIA in some ways fits, but also doesn't really fit that bubble narrative given that fundamental backdrop.
And I think also what's interesting about that is we're just about to kick off a new earnings season for this next quarter. Earnings expectations are for this quarter are 5% year-over-year growth, which is quite low compared to what I've seen in prior quarters. First, last quarter was double-digit growth over the last 12 months. So the market is somewhat coming in with kind of lower expectations and easy hurdle rate. And I think one thing that we kind of can agree is if the market can overshoot expectations, that's almost always a catalyst for further momentum. And so we don't presuppose what we're going to see. But at the same time, you really need to have kind of outsized expectations in the near term to start to see the signs of, okay, we've really reached a market bubble. And clearly these things can run for a long time. Then as we go through the rest of the list, and I'm not sure I'm going to hit bingo on the market bubble, but when I look at kind of G, it fits again with this AI theme, and it's really about gigawatts. Where is the largest source of spending in this country happening from a CapEx standpoint. It's really the build out of the data centers. And I think we're still early in that cycle. And I think in some ways you can compare it to the build out of railroads in the 1800s, build out of the internet in the 1990s, other kind of large infrastructure programs that we've seen over the last 200 years. And we're in the earlier part of that stage. So it's hard to imagine how much many of the tech names have rallied, and then also say we have this big AI CapEx cycle that's occurring that's really driving markets. And so in some ways, when we looked at comparisons, you can make an argument that we're somewhat in a version of the 1990s. It's a little distorted when you look at some of the macro fiscal profile of the United States. But at the same time, from a market sentiment, market expectations, there's an encouragement of risk-taking, and there's an encouragement of building out long-term investments that hopefully are accretive 5-6 years from now in terms of generating an ROE and ROI on those investments.
And on that last point that you said, where there's this almost risk-taking behavior that is potentially building in market bubbles, one of the aspects I had was gambling mentality for G. And it sounds a little funny to say, but sometimes when sentiment gets stretched and you get into these type of bubble-like environments, you get almost this investments act as gambling, almost action that's in markets. So things become a little bit more speculative in nature, kind of detached from fundamentals. And it's hard to say that that's what's going on in markets today, but there might be some aspects of that, whether it was the meme stock example from a couple of years ago. I think that's a really good one to point to. You could argue maybe crypto kind of fits that bill today too, with a lot of money being funneled in that area and a lot of new products being created as well. So this is another one of those behavioral aspects that I do think takes hold in markets, but maybe we're not seeing it broadly across the board today.
Yeah, and I think what's interesting about that, just to pat ourselves in the back for a moment, when we talked in January, we talked about what are the big themes that we could see for this next year. One of the things we talked about was this kind of market euphoria that existed. And one of those was looking at crypto and Bitcoin, which you've seen kind of significant rallies, especially in the last 30 days or so. And I think also thinking about that as the impact of tariffs, the importance of AI, and this is the animal spirits, that gambling mentality, that belief, that 100% belief in the future that you can't fail, is what sets the markets up for a bigger bubble over the next 5-6 years. So I grew up in the Bay Area. I remember what the 1990s were like. I remember all the times of can't fail. But I also remember what happened in 2000 when you kind of could see that shift. And so I think that's one of the things to think about is we're not there yet, but we're certainly building towards some of that kind of real animal spirit mentality.
Yeah. And maybe just to round out the bingo card for I think this pulls together a lot of the elements that we've been talking about today, but mine is over-the-top valuations. And you've heard us say that maybe there are a few names in the index that arguably could be in a bubble or are overvalued today. And when you look at everything at the index level, I think most metrics are going to say the market's pretty expensive today. But one of the challenges that we're facing as investors is that markets can be at all-time highs. Things can profile as expensive, but history says that expensive things can stay expensive too. So we can stay in this environment for some time. Valuations can continue to expand from here, especially given some of the backdrop items that we've walked through today.
Yeah, and I think for me, O really equals, for many folks, overweight equity positions, and don't want to be alarmist. That's not a negative. Look, there's a lot of reasons to stay invested in these markets, a lot of bullishness that exists. But I think it's a great time to remind everybody, let's be as diversified as possible. Let's not get stuck trying to guess the movements of policy actions over the next several months, and really focus on our long-term objectives, holding to our policy targets, and really selling down assets that have exceeded expectations, and over time investing in those assets that have underperformed. I think that's really the discipline we're hoping to bring for the rest of the year. And hopefully markets are stable. But as we saw, volatility can spike up, and if it spikes up at high enough level, we'll certainly be there to look to rebalance back into markets. So with that, that's our bingo card for the quarter. You may see it again at some point, but probably not this next quarter. And just as we approach kind of wrap up, just a couple logistic items. Recording slides will be available on the website. In terms of questions, did get a couple questions, Jen, more related on kind of government policy and fiscal policy. And so maybe kind of throw this one to you. With some of the policy shifts and the recent budget bill that we're seeing from Washington, it looks to be that many businesses and banks are kind of looking at this as almost as a business as usual kind of environment. And if there are any risks, maybe they're kind of far off, 5 years out. Can you talk a little bit about NEPC's view in terms of kind of thoughts on some of the recent policy shifts and actions?
Sure. I think the first thing that I just mentioned, I talked about this a little bit earlier, but tax uncertainty was something that businesses were dealing with earlier this year. And so with the passing of the tax bill, that is one maybe less concern moving forward. And I think in particular for small businesses, that's kind of a big deal there, since the tax burden can be pretty significant. So a little bit of business as usual, just in the sense that it does extend a lot of the existing tax code. But what's interesting from a little bit more long-term perspective, over the next couple of years at least, this bill is going to be stimulative. And what we're seeing is that it is going to add quite a bit to the deficit over the next 10 years, but there is a nominal growth impact that'll have that is more front-loaded versus over that long term. So we could see some benefits in the near term overall that maybe aren't priced into the market at present either.
Yeah, and I think as we look at it, the risk not necessarily is the deficit today, but more of if we saw a surprise recession, how quickly would the deficit expand to double-digit levels, and then what would be some of the kind of shifts and kind of triggers that would occur in terms of spending from DC that would really force spending to come down and also require deficits start to shrink over the next couple of years. So I think it's unlikely that we see deficits come down over the next 5 years, but I think it's also fair to say that's probably not the top of the list of things the market is concerned about, unless we saw two things. One, the Fed holds interest rates at current levels, and we also saw a recession that saw deficits expand quite a bit. That would cause a little bit of a fear in terms of markets holding onto treasuries, but I think that's probably more of a tail risk for both of those to occur at the same time. All right. So with that, thank you all for joining us. As I mentioned, this will be provided and shared online if you'd like to watch again. But wish you all a great and wonderful summer, and looking forward to chatting with you again in a few months. Take care.
Thank you.